Well, Excellencies, ladies and gentlemen, we are going to start our panel on energy market development and their effects on GCC. So I was here for the last panel, and I'm informed that I'm chair of this panel as well, because Dr. Al-Falasi could not join us, unfortunately, for this panel. So I'm going to chair this panel. We are having two very distinguished guests to share their thoughts and research with us on this issue. I'm going to first give a very short bio. You have the extensive bios. I will not be able to completely say all the extensive and great work the two experts in this panel did, and I would just briefly tell the bio of each one and introduce them, and then I will ask the first speaker to start the panel. So our first speaker is Mr. Timothy Gould. I hope that I pronounced it correct. Okay. Dr. Gould is here with us from Paris, from IEA, International Energy Association. He's head of Unit for Resources and Investment at IEA. He's working in the Directorate of Global Energy Economics under the chief economist, and he's a contributing author to the World Energy Outlook series. The agency's authoritative analysis of long-term global energy trends and challenges and coordinates the supply-side aspects of this work. He has also played a leading role in producing the in-depth outlook published on the Caspian region, Russia, Iraq, Brazil, and Sub-Saharan Africa. He as well been senior advisor to the Secretary General of Energy Charter in Brussels, and has 10 years of experience in Eastern Europe, primarily in Russia and Ukraine. Mr. Gould has been graduated from Oxford University and has a postgraduate diploma from School of Advanced International Studies at Johns Hopkins University. Our next speaker is Dr. Andrei Belli. Okay. Dr. Belli has been a senior researcher at the University of Tartu Center for EU and Russian Studies, and he also worked as the Higher School of Economics in Moscow. He taught there. He has extensive experience of consulting, and he has been in the consulting business for more than a decade. He's a published author. He has many publications and interviews. So I would like to invite Mr. Gould to start his remarks and share with us his thoughts.
So we just need to change them around. Thank you very much, Chairperson, apologies. And thank you very much to you all for being here today and extending this invitation to me to speak. It's a great honor to represent the International Energy Agency at this distinguished conference. And like my other speakers, it would be remiss of me if I didn't thank very sincerely the organizers for the exceptional welcome that they have provided for us. My presentation is going to be based on the World Energy Outlook 2014, which was published 1 week ago. So I'm going to cover a range of energy market developments and offer some hints as to why these may be significant for this region. A first point that I wanted to emphasize is that some look at the energy trends today and they see grounds to believe that energy security threats are manageable, particularly when they look at the current situation in the oil markets. One immediate point I wanted to mention is that please don't get too relaxed on energy security. From our perspective, there are some pervasive issues that will need to be addressed, both current issues and issues that we see coming in the future. And one clear example of that is the way that the current turmoil in Iraq, Syria, and Libya plays into our analysis of the future of oil markets. And another example is the resurgent debate in Europe over security of gas supply because of the events that Jack was talking about in relation to Ukraine. We also see very mixed signals coming in the run-up to an important meeting in Paris next year, the UNFCCC talks on a potential agreement on climate change. On the one hand, you see the inexorable rise of CO2 emissions, up again by around 2.6% in 2013. On the other hand, you also see in a continued deployment of fossil fuel subsidies at a level that really encourages wasteful consumption and additional emissions. In our calculation, the value of these fossil fuel subsidies in 2013 was more than $500 billion, and that's 4.5 times the amount that was devoted to supporting renewable energy. But there are important policy signals and evidence that policy works, and one example I'd like to bring to your attention is say, road transport efficiency. 3/4 of the new cars that are sold today are now subject to fuel efficiency standards. And you can see that that's having already a real and tangible impact on the evolution of oil demand. But the question we ask then, if policies can be effective in shaping energy trends, will they be effective enough? So, is the future going to be driven by policies, by policymakers who get ahead of events, or are they going to be more reactive to things that happen in the market or things that happen in the global climate? I'd like to just give an overview of some of our energy consumption trends to 2040, which is the horizon for our forward-looking projections. Over the last decade, since 2000, you've seen a very substantial increase in global energy demand by around 1/3, and almost half of that, 45%, has been due to the rise of energy consumption in China. OECD demand, by contrast, has been relatively stable, and we do expect that to continue out to 2040. That looks like a fairly, uneventful line for OECD energy consumption, but beneath that there are some quite dynamic shifts taking place. Oil consumption falling, as we'll see in a minute, natural gas consumption on the increase, and renewable energy sources particularly increasing rapidly. But the other important thing is that, in our view, China will no longer be the driver of developments in energy markets to the same extent that we've seen over the last 10 to 15 years. And the reasons for that are firstly related to policies. We'll talk in a minute about the Chinese attempts to cap energy consumption growth through energy efficiency measures. Also because of the rate of population growth and economic growth we see being lower than it has been in the past. So it's really other parts of the world that are the drivers of energy demand growth. And by those other parts of the world, I particularly highlight India, parts of this region, parts of sub-Saharan Africa, parts of Southeast Asia, and Latin America. So those will be the key areas which will decide how fast the global demand for energy grows. If we move on specifically to oil demand, we see the same dynamics in play, but even to a more exaggerated extent. In the OECD, oil demand is now in a period of structural decline due to saturation effects in road transport and the impact of efficiency policies. So when we talk about demand growth, some of that will come from China, India, and other parts of Asia and Africa. The Middle East, the demand from within this region is an extremely important component of future growth. And that takes us, in our view, up to around 104 million barrels a day by 2040. And demand is concentrated increasingly in just two sectors of the economy. So we're talking about the transport sector, and we're talking about petrochemicals as a feedstock. Outside those areas, we see oil demand, again, structural decline, And even in transport and in petrochemicals, the share of oil in consumption in each of those sectors is declining slowly. In the transport sector, because of the increasing penetration of natural gas vehicles, biofuels, and so on. Now then, so we need to find 14 million barrels a day to 2040. So the question we ask is, where is this likely to come from? And what we see is that the growth in oil production is only likely to come from a relatively small number of sources. Those sources for us are the US, Canada, Brazil, and the Middle East. So while there is a view that current developments in oil markets, particularly in North America, have to a degree sidelined the Middle East or moved the Middle East away from the center of the global oil market discussion, the IEA does not subscribe to that view. We still see that the Middle East is very much at the center of that debate, and I will point out why in a second. Because if we look at the countries that will be producing more oil in order to meet that kind of demand growth, and if we exclude the US, Canada, Brazil, and the Middle East, then we see that the remaining countries don't move us closer to that goal. They, in fact, in aggregate, move us further away. And if we add the US to that picture, we see some continuation over the next few years of the extraordinary growth that you've seen in tight oil. But in our view, that starts to plateau in the 2020s, and it falls back in 2040 to around the levels that you see today. Canada also makes a very significant contribution, primarily because of the oil sands. There, the big question that we ask ourselves is, how does that oil get to market? Because there is unresolved issues over the pipeline routes that would bring that oil to market. Brazil, likewise, a large contribution, although here too we have questions about the complexity and capital intensity of some of these very large deep water developments. But then the remainder, this large and growing wedge of incremental oil supply, in our view, needs to come from the Middle East. And we see some encouraging signs here, and I think I would include them in those encouraging signs. Also, the developments that we see in Abu Dhabi with the focus that you have on enhanced oil recovery. But we also see some warning signs, both in terms of the sort of fiscal demographic pressures that we see that could, in our view, constrain the amount of investment that is made in the upstream oil sector, but also naturally because of the security situation in some key countries. So you might assume from this chart that there's plenty of time to resolve this situation because the increments from the Middle East are only required around 2020. Again, we think that's misleading because of the lead times that are required for upstream investment. So in order to see that incremental production in the 2020s, the investments need to be made today or even yesterday. So that is for us an important consideration when we look at the risks that may be facing oil markets in the future. So if we put the last two slides together, we get some implications for trade. And I'll focus first on crude oil. And I wanted to illustrate this by looking at the so-called region east of Suez. So for us, that's Middle East plus all of the Asia-Pacific markets. And traditionally, the east of Suez region has been a net provider of crude oil to the international market. What we see today is that that is no longer the case, that Middle East exports of crude, which by no means all go to Asian markets, but around 75% in our view today go to markets in Asia. They are roughly equivalent in volume to imports from India, China, and other Asian countries. But in the future, you see that there is actually quite a large and growing discrepancy between those two numbers. So while crude export from the Middle East increases, demand from Asia increases much more rapidly. So that implies that the Asian crude importing countries start to draw in supplies not just from here, but from an increasing number of other markets around the world. The implication being that there is a slightly more competitive environment for Middle East crude exports to these markets, but also a concentration of vulnerability in these large Asian importers to the implications of any physical disruption to supply. An important element in the future picture of crude oil balances and trade is what happens in the United States. And here there is sometimes a misleading impression that the US is poised not only to become an exporter of natural gas, but also to become a net exporter of oil. And so we just wanted to make it perfectly clear that while North America as a whole may be a net oil exporter, that is not true for the United States. So if we look at the balance, there are some very interesting things happening, but you still see a large deficit, net deficit, even in 2040 for the US oil balance in our projections. But there are some interesting developments, particularly in the volume of crude that the US is projected to take from outside North America. So you see that that wedge is gradually diminishing as, in our view, the US sources much more of its crude from Canada and also from Mexico. And the US is also poised to become a very important player on the oil product export markets. You see that there's, by 2030, around 2 million barrels a day in our projections of product exports. In the period to 2025, that is largely LPG, diesel and LPG. Then in our projections, LPG exports tail off somewhat, and it's more diesel and eventually gasoline as well that the US would be providing to international markets. Gasoline, as the US demand for gasoline gradually decreases, also as a result of new CAFE standards, fuel efficiency standards in that country. So if I can say a word about gas, but I will leave the primary gas discussion to my colleague Andrei Bieli. A few points. There's clearly a discussion at the moment about security of supply in Europe. In our view, that discussion is eased somewhat by the rise of liquefied natural gas, LNG, over the period to 2040. So total gas demand increases by around half. LNG supply almost doubles. And it's not just a question of volumes, it's really a question of diversity, because you see some new players coming in, US, Canada, big expansion in Australia, East Africa, which is largely Mozambique, and the Russian projects that are under consideration and in some cases underway. What this does not do is change one of the most important economic equations in the global energy system, which is the competition between gas and coal. So the expectation that LNG is going to fundamentally change the economics of producing electricity from gas versus coal is, we think, a mistake. If you're importing LNG and you're importing coal in an Asian country, then it is roughly twice as expensive to generate electricity from gas as it is from coal. So LNG is not going to change that substantially. What will change the position of gas are the policy drivers that are attached to gas use in some major parts of the world among the importing countries. And that means essentially the need to provide cleaner electricity, cleaner heat, and also mobility in some cases for Asia's large and fast-growing cities. A quick word on coal, since coal is often forgotten in conferences, so I wanted to say a couple of words about it. It's really been, alongside renewables, the big story of the last 10, 15 years has been the extent to which coal has met the increase in global energy demand. Almost half of the increase in demand over the last 10 years has been thanks to coal. But we do see that advance in coal's position is going to level off, and that's primarily for policy reasons, for environmental reasons. If you look in the United States, in our view, coal demand already peaked some time ago. European coal demand also peaked some time ago. The same is true of the United States, where coal, in our view, will suffer because of the new clean power plan that's been proposed earlier this year. But interestingly, also in China, as a result of, again, policies to cap the share of coal in the national energy system, and also to diversify the electricity mix. So you see a plateau in coal demand in China, in our view, and it's really India that leads the expansion of the coal consumption around the world. So in our view, that highlights the importance for the future of coal, not only high efficiency power plants, but also the readiness to deploy CCS when it becomes available. So in an uncertain environment for fossil fuels, those become key indicators for the future of coal. A few words about the future of the power sector. This is global installed capacity today, around 6,000 gigawatt hours. People imagine that the main challenge for the future of the global power system is the increase in electricity demand. We would add to that the fact that, in our view, around 40% of today's power plants are going to retire before 2040. So you need to also replace the capacity that you're going to lose, and that's particularly a concern in many OECD countries with an aging stock of capacity. And then you also need to add more than today's total installed capacity in order to meet electricity demand by 2040. In the Middle East, our analysis suggests that there are many competitive technologies for power generation, but a feature of the Middle East system of power generation is also the high use of oil in the power sector. So when we ask ourselves in which technologies are going to find the investment money over the next decades, a crucial variable for us is at what price oil will be available for the power sector. And if indeed oil is only available at the international market value, then you see that many other technologies become very competitive. Renewables, for us, are another big story of expansion over the next 25 years. The largest expansion being in wind and solar PV, the largest volume still coming from hydropower. That level of expansion creates certain market and technical issues that will need to be resolved. And it also requires a certain amount of support from governments, since these technologies cannot compete on their own against other generation technologies. But the price of those subsidies, in our view, peaks around 2030 and comes down in line with falling technology costs, and also the fact that some of the more expensive commitments to subsidize renewable energy by then start to expire. I wanted to say a few words about a focus area that we had in this year's outlook, which is nuclear power. And this is obviously an area that is relevant here as well. The key finding, in a sense, is that we do see that nuclear expands both because of CO2 concerns and also because of energy security drivers. But there's really no renaissance in nuclear power. The share of nuclear in global generation goes up, but only from 11 to 12%. In many countries, in many parts of the OECD, the key issue is retirements. So 75% of OECD nuclear capacity is more than 25 years old, and a substantial amount of that is going to retire over the period to 2040. So even if nuclear comes back in Japan, as we assume it will, you still have a net reduction in nuclear output from Japan and the European Union. India and Russia make substantial contributions, but it's really China that adds the most new nuclear capacity over the period to 2040. So if we look at the overall balance of nuclear capacity in the world, today it's around 80% in the OECD, 20% in the non-OECD. By 2040, that's much closer to 50-50. Two big challenges that I wanted to highlight in relation to the nuclear expansion. One is the issue that I was just mentioning. 200 reactors are due to retire between now and 2040. The decommissioning costs are substantial, $100 billion in our view, and regulators and utilities need to make sure that that money is put aside. The second is the question of high-level nuclear waste. It's now 60 years since the first nuclear power plant was started operation, and there is still no permanent depository for high-level nuclear waste. This is a question that will need to be resolved, especially as the volume of spent fuel doubles, in our view, over the period to 2040 under our projections. My last topic is the question of climate change. As I mentioned at the start, there is to be a very important meeting in Paris next year, and in our analysis of the implications of that meeting, we looked at the starting point was the work that was done by the IPCC to come up with the concept of a global carbon budget. That is the amount of carbon that can be emitted over the long term in order to stay within a 2-degree trajectory. That's around 2,300 gigatons, and up till 2012, the world had already emitted more than half of that. Now, the implication of the scenario that I've just presented is that that budget, which is a long-term budget, is entirely used up by 2040. And since emissions are not going to drop to zero immediately after 2040, that's a strong signal to policymakers that additional efforts are required if the world is to remain within the level that the IPCC would deem as avoiding the most severe consequences of climate change. What does that mean? It means a large expansion of low-carbon investment, well beyond the levels that we have today, and well beyond the levels that we anticipate under this main scenario. So there are some encouraging signs. Most recently, of course, the US-China climate deal, which was announced last week, but there's still a long way to go. And in conclusion, some of the key points that I would like to underline: concerns about energy security not going away. For the long-term outlook for oil markets, the Middle East very much in the center of that. So therefore, concerns from our side about the implications of any instability on investment. And the strong message that we need far-sighted government policies in order to steer the global economic system and the energy system onto a safer course. Thank you very much indeed.
Thanks, Mr. Gul, for your very informative presentation. Our next presenter is Dr. Belli, and you have 20 minutes, please, to say your remark.
Thank you very much, and I will join previous speakers for thanking for organizing such a great event and for giving a floor also to me to give this interesting and fascinating topic such as international gas markets. And you just heard from Mr. Tim Gould that how important the challenges are in the world energy markets, in the global energy portfolio. There are many uncertainties. As he mentioned, we didn't expect such a growth in renewable energy. So we didn't expect such a sustainable high oil price till it happened recently. We didn't expect such growth in LNGs. And here also the question, maybe the coal industry is not that dying as the International Energy Agency forecasts. So here I would like to quickly refer to quite an interesting economic model which exists in basically already for a couple of decades, which is the wolf-rabbit relation. It means that when you have a lot of rabbits, wolf can have a place to grow and their numbers grow. But once their number is significant, they practically eat rabbits. And so the number of rabbits decreases, and therefore the wolf numbers have to decrease as well. So it's more or less what happens in the international energy market. You have the high oil price, the rising oil price, which stimulates alternative energies, which stimulates interfuel competition, and which also stimulates a decrease in the fuel replacement costs. However, all these trends lead to a cycle of oil price decrease. And that practically kills the interfuel competition. It actually decreases chances for fuel replacement costs, rises then the demand for oil and gas, and therefore gets us back to the traditional energies. So, but in energy sector, we don't have two components actually, like in the aforementioned model. We basically have three. One is the developments of the world economy, in particular demand for energy. Second would be developments in oil. And then third, the most interesting, at least in my eyes, alternative to oil energy, which is the natural gas. So, as I was asked to present some points about new context in the markets, what do we see? First of all, at the level of the world demand, we see that actually the demand growth rates decline. And at the same time, we see an increasing interfuel competition, which have been occurring for the last 2 decades at least. Then at the level of oil markets, we see that there is a decline in profitability margin in spite of the oil price increase. Basically, it means that fuel replacement costs have been declining, but the marginal costs for production for oil industries have been rising. And now, practically, we see that a new cycle of low oil prices started. And then in the natural gas markets. So, first of all, we see that with the lower oil price, the oil indexation of gas prices becomes more competitive. However, gas-to-cost competition is growing and especially crucial in certain parts of the world. And above all, we have also growth in new technologies, especially in the liquefied natural gas. So let's have a look at these elements in detail. So first of all, the economic growth, which stimulates somehow, which conditions the energy demand growth. We see that actually the recovery from the financial crisis of 2009 has been lower than expected. And we see also that China's development, China's economic growth also declines. And then we see altogether BRICS countries, Brazil, Russia, India, China, and South Africa, they basically have their development rates, their growth rates decline. And that actually affects the global energy demand, the global oil demand as well. What about the fuel mix diversification, which was occurring? And then here I will show quickly a comparison between the two graphs of how the global total primary energy supply structure existed in 1973 and how actually it reflected in 2009. What do we see? We see decline in the oil share from 49 to 34% in the global total primary energy supply. We see only a slight increase in coal and a slight increase in gas. That basically demonstrates quite a significant development in interfuel competition and in the fuel replacement costs decline, right? So basically, such a diversification is possible when the fuel replacement costs go down. And what actually we see, that with each hike in oil price, we see that the fuel replacement costs go down. And that is actually a non-reversible trend. What is important to mention regarding the oil development is the increasing marginal cost curve. It actually means that for oil producers, the increase in oil price is not always a good news. Look at this graph, which was developed by a recent study by Cambridge Energy Research Associates, which demonstrates the following, that the green line, which means the average world oil price per year, was going up a part of the small period in time in between 2008 and 2009. And the profitability margin for oil companies have been rather going down. And the bottom of the profitability margin coincides with the highest annual average oil price. So that it actually means that the high oil price is not always a good news for the oil producers. At the same time, we are certain that the low energy price is certainly bad news for the oil producers. So let's see what happens in the gas markets. The development of the oil markets, of the oil demand and the oil price stimulated gas markets. Stimulated in two ways. First of all, new technologies such as shale gas revolution in the United States, which was actually possible because of the oil price increase in 2007, 2008, and also by the fact that the oil price stimulates gas consumers to go away from the oil index prices. So what do we see here? That's actually how things have developed for the last 5 or 6 years, is that in North America, as well as in the United Kingdom, and partially in some parts of Europe, especially in the northwestern Europe, in the Netherlands and Belgium, we see a development of the gas-to-gas competition, which practically slipped away from the oil index prices. It means that gas supplies have been important enough and the prices were not matching the oil anymore. So there were no need to index to the oil. And if I may just remind that the very initial rationale of indexing gas price to the oil price, which started in the mid of the past century, especially the 1960s, consisted to provide the gas consumers a price which is a little bit lower than the oil, because oil is easier to produce, it's easier to store, it's more elastic at the production level. So in order that the consumer sticks to the natural gas, we make him pay a little bit less than the price of oil. But once you have a number of gas producers, such as shale gas developers in the United States, or additional gas supplies which occur to be in the United Kingdom and in northwestern Europe, practically the oil indexation loses its sense. However, when we look at another part of the world, the oil indexation kept its rationale, especially in the fast developing Asian markets. And as the previous speaker highlighted, Asia is the main attracting pole for the energy demand, and especially the hydrocarbon demand. So for Asia, there is a very big sense to keep the indexation with the oil price. Although there are some attempts of Asians, especially of the Japanese and the South Koreans, to go away from the indexation, grosso modo, generally, we see that for a fast developing market, the indexation is still quite valid. The indexation also remained in most of the markets in Europe, practically a part of the United Kingdom and the Netherlands. We see that more than half, at least 55% of the European gas supplies are indexed to oil. How does it reflect on the price? So you can see that is actually a shot of the price at the second half of 2013. You see that actually the regions where the oil indexation exists, the prices are much higher than in the areas where gas-to-gas competitions have been developed. If you want to have a more detailed and more time expanded picture, then you have it here. You see that actually the highest price in green is the Japanese one. And then you have the United Kingdom, which follows from time to time the oil indexation and from time to time decouples from it. And then you have the Henry Hub, the United States natural gas price, which since 2009 clearly decoupled from the oil price. The liquefied natural gas, and it has been mentioned by the previous speaker, provides a new challenge for the natural gas markets. There are more producers and more countries desiring to consume liquefied natural gas. You see here the historical graph how the LNG supplies were developing. At the end of the 80s, we had only 80 million tons of LNG produced in the world, and now we have more than 230. And new technologies in the liquefied natural gas also reflect a challenge in the field. So, quickly going to the gas OPEC, I would say gas OPEC meet, which was elaborated within the gas producers, gas export and exporters and producers countries forum, where you have 3 countries, mainly Iran, Qatar, and Russia, occupying more than 55% of the gas reserves. But this big troika does not constitute a market power, and therefore cannot influence the price. Therefore, we cannot say that the gas coordination group can represent a weight similar to OPEC, even though even OPEC actually is under question as a power in the energy market. So, very quickly, what are the perspectives? The oil price decline would stimulate the energy demand. So the oil markets, the low oil price is cured by the low oil price. So we would expect that in the midterm perspective, the oil price would go up again. However, now we are clearly entered in the period of the low oil price, and that we have to be conscious about. The oil price will not recover in the short run. That's actually quite a certain assumption. And for the gas markets, it seems that the indexation to oil regains its competitiveness, but again, higher competition for the gas markets, higher competition on the supply side, and we see rather that supply side wants to stick to the indexation, but many markets would like to get rid of it, get away from it. So it's not a good context for the natural gas markets, at least in the short run. And we see also increased political risks, which have been mentioned in the previous panels, and at the same time, a decreased profitability, even in the context of the higher oil price. So in this context, I would say that existing suppliers of natural gas, and if you're talking about LNG, existing suppliers of LNG, have an advantageous position because they're already there and their investments have been paid up, are amortized. For the new suppliers, such as Australia, United States, or for LNG, Russia, for gas pipes, it's a totally different story. Obviously, the situation is much more difficult. And although I'm certain that this model can be easily applied to the world energy markets, I'd say that there are a number of uncertainties in the long run, especially due to the political reasons. Thank you for your attention.
Thanks, Mr. Belli. I would like to thank our distinguished panelists for sharing their very interesting, informative research with us. Mr. Gul had a very interesting overview of the market dynamics, supply and demand, and how the market is going renewable energies. Also, he mentioned that U.S. is going to have a very major role in the supply increase in the next decade. Mr. Belli was talking about different pricing methods in the gas markets, the competition, and how one has advantage about the other one. I would like to open the floor for the discussion and question. We have a limited time because we have to finish and close our session by 1 o'clock, and then we will have a short break to change the setup of the scene, and then we will come back again. So I would like to open with the lady in front. She has a question.
Thank you for the very inspiring and informative talk. I like to thank both the speakers, even those in the morning. It was really too good. Even you, Sarah.
Thank you.
What I like to know is, because I don't know much about this, is shale gas and natural gas one and the same? If there are any changes, what are they? The price difference is much. So too does the quality. And lowered oil prices are there. So in that case, the cost of living and such, those should come down actually. But it is not. So can I get somebody to talk about it, please?
Okay, so this question is for both of the panelists, or would you like to answer?
I can certainly say a word that the difference between shale gas and other conventional gases is related to the method of extraction. The gas that you end up with is basically the same. It's largely methane. The quality, as with other, it can vary from play to play, but essentially the divergence is similar across the range for unconventional gas that it is for conventional gas. So for all intents and purposes, you can consider this as a source of gas production like any other source of gas production. The differences are just in the upstream and the additional effort that you need to make to get gas from impermeable rock. That's the essential difference there.
Would you like to add any? No. Okay, I would like to ask the people to please introduce yourself and mention the place that you are affiliated with. The gentleman in the second row. Behind.
Okay, thank you very much. Abdullah Muhammad Al Hassan, University of Jazeera, Sudan. I have a question for Dr. Timothy. From your presentation concerning our global energy outlook, it was clear that we are going to continue depending on the fossil fuels as a major source of energy. That means more emissions of CO2 gas and severe consequence of climatic change phenomena. My question, what is the appropriate policy to be taken in consideration to promote the concept of energy efficiency among the energy consuming sector? Second question, what is the expected place of the green energy in our global energy balance in the coming years? Thank you.
Yes, just to say that the current share of fossil fuels in primary energy supply is around 82%. In our projections to 2040, that goes down to around 75% because of the significant expansion of renewable energy resources. As we've seen, that is not enough to move us towards a trajectory in emissions that is consistent with a 2-degree outcome for the world. So there are different components to move us away from that. One is a further expansion in low-carbon sources of energy, a deployment of technologies that break the link between the use of fossil fuels and the resulting emissions, such as carbon capture and storage. And then the issue which you focus on is very much a key one for us, which is energy efficiency. the keys to energy efficiency, the first one is getting the pricing right, in our view. And that means a removal of subsidies to fossil fuel consumption. But policies play a big role in our outlook. And what I try to argue at the start is that policies can actually make a very significant difference in affecting the way that energy markets develop. If you look at Europe, for example, Europe electricity demand is increasing, it's essentially flat. And that it continues to be flat in our outlook. And the main reason for that is because even though households have additional appliances, that the efficiency of those appliances is sufficient to compensate for the rise in demand for energy services. So policies, fuel efficiency standard, appliance standards, all of these have an extraordinarily important role to play, alongside some efforts to raise consumer awareness about the way that they use energy. So that, in short, I would say those are some key considerations.
Okay.
Thank you very much. It seems from the presentation of Dr. Actually the oil products, not the crude oil, the oil products in the United States in percentage terms are shrinking regarding the competition due to competition of other new industrial countries and raising new industrial countries. Is that satisfactory for the United States to see this, or they are looking to develop their industrial oil products to be more competitive and to change these expectations in the future? Thank you.
So yes, our expectation is that the oil product demand in the United States would continue the decline that we've seen, and it would continue to decline primarily because of reductions in oil use in the transportation sector. We do see some continued strong demand for oil in the petrochemicals side, but there's also strong competition there from relatively cheap feedstocks on the gas side. So our expectation is that oil demand in the US would be on a declining path. Now, whether that is a satisfactory outcome, I believe that a number of these developments are linked to policies that are specifically put in place with that aim in mind. So when you look at the combination of robust production growth and declining demand, you get a transformation of the position of the US in oil markets. And that was one of the points I was trying to make. Much of that transformation is already visible. I think some of it still has to play out over the next 10 to 15 years.
Okay. We have time for 2 more questions.
Thank you very much, Dr. Sarah. My name is Dr. Ali Lamoudi. My questions is to Dr. Gold. Dr. Gold, as you mentioned about the climate summit in Paris 2015, and it's a global event, where all the world is expecting the correlation between climate change and the global oil. What do you think, in your opinion, the correlation between the global oil market demand, which you mentioned, and the climate change index? What's in your opinion, the correlation? Is it going to increase, decrease, steady, and how the index is going to be? And thank you.
So thank you very much for the question. We also model an outcome for the global energy system which is consistent with a 2-degree world. So a long-term trajectory for emissions which keeps the long-term rise in global average temperatures to within the 2-degree limit. That has implications for fossil fuel demand. Those implications are most severe for coal as the most carbon intensive of the fossil fuels. Coal demand is significantly lower in a climate scenario than in the one that I presented. So where you see coal demand flattening off in the main scenario, it really declines quite dramatically. Oil demand also rises to 2020 and then goes into an overall decline compared to the picture that I just presented of a gradual rise to 104 million barrels a day. So in a climate scenario, oil demand would be below today's levels by 2040. And that is because of the carbon penalty associated with oil consumption, particularly again in the transport sector. So you see much more rapid expansion of alternative forms of mobility, whether it's electric vehicles or biofuels or other measures. And the cars that are on the road are then much more efficient. There's also implications for natural gas, although natural gas is the least affected of the fossil fuels under those circumstances. So in the case of natural gas, consumption in 2040 is higher than it is today. I think that you can see that there is the possibility for a more rapid expansion of electric vehicles. There is potential for hydrogen fuel cell vehicles. I saw that one of the major car manufacturers is planning to bring out a model in the relatively near future which will be running on hydrogen. However, in our main scenario, these have relatively limited impacts on the way that the market evolves. For the reasons that you can see today, it's difficult to incentivize consumers to switch away from a technology that functions adequately, perfectly adequately in most cases.
And our last question, the gentleman, yes, that in the back.
I'm Obaidullah Al-Hassan from Abu Dhabi University. My question is for Dr. Belli. You said that the increment in oil prices doesn't necessarily reflect a good news for the producer. Can you clarify this point? Why?
Well, basically, the marginal costs for production, they rise with the oil price increase. For example, the cost of equipment, the cost of services, all of these goes up, right? And automatically the general cost, the marginal cost will be higher. Though, let's say when you have $60 per barrel of oil price, you may have 15% of the revenues. But because of the costs, general costs of equipment and of services grow with the oil price, so the oil price when it's 90 can give you only 10% of profitability.
Thank you. I'm sorry that we couldn't answer all the questions. There is a gentleman, if you could just shorten your question, we can, but we really don't have so much time. Would you like to ask your question? Okay.
Assalamu alaikum. My name is Mohammed Asb Shamsi. I'm from General Secretary of Executive Council. I'm not going to specify the person to answer. It's up to you. Regarding, first of all, in the slides, there wasn't included the oil production growth. Regarding the Iran, you included Middle East, you included the other nation, but there are specific countries that you didn't mention it. The second thing is regarding the emissions. I mean, we actually do highlight the point about emissions need to be reduced and everything, but the technologies actually that we are investing in now, currently, diverse from the oil to the gas. Nevertheless, the trend actually saying that people want, or countries is going for the renewable energy, which actually so far at this point isn't that effective or efficient. Even the electric cars, I mean, to be honest, isn't same as the car who's going with oil or gas. I mean, or the oil itself doesn't same.
Sure, thank you. Okay, you would like to.
I will answer. So it's again the dynamics, the cyclic dynamics, and most the electric cars. I'm not sure that is efficient, but for example, when you look at the power generation in Germany, coal and renewables outpassed natural gas for the last year. For example,
The margin of decreasing the percentage of efficiency doesn't indicate like it's a really huge number.
Yeah.
It's differ from place to place, and not all the countries adopt the technology itself. So how you can be sure that oil or gas going to be decreased to 2040, even the shale oil, the new technologies
Thanks for your
might
question.
increase.
Sorry, sir. I'm very sorry to interrupting you. I
That's
encourage you really definitely to approach the speakers, but I know that one of our speakers has some comments for...
No, just to say that in the slide that I presented, I highlighted the US, Canada, Brazil, and the Middle East. There are, of course, other producers that do see an increase over the next few years, and even an increase in 2040 relative today. But compared to the ones I show, they are relatively minor. And if you take the rest of the world in aggregate, then you do see that the average projection then takes you down relative to today's levels.
Thank you. I know we had a very interesting presentations. There were many questions, but I really encouraged you to please approach our speakers during the next break or during the lunch. We have a very short break before our next guest speaker, His Excellency Jose Maria Aznar, speak for us. So please have a very short coffee break. They need the room for some change on the scene, and then we are back in 5 minutes or 10 minutes. Thank you.
Bismillah ar-Rahman ar-Rahim.
In the name of God, the most gracious, the most merciful, Your Excellencies, dear guests, we would like to welcome you once again in the ECSSR, and we would like also to extend our thanks to you for participating in the 20th Annual Energy Conference that we conclude today. We will give the floor now to His Excellency Jose Maria Aznar, President of the Government of the Kingdom of Spain between 1996 and 2004. You may take the floor, sir.
Good morning, thank you very much. I can express my gratitude to Emirates Center for Strategic Studies and Research for this invitation. For me, it is a very great pleasure to be here in Abu Dhabi, in Emirates, Ambassador of Spain, dear friends. Energy and political initiatives surrounding their use, control, and conservation have always been on the center of the world scene. However, in recent years, the importance of energy has become even more evident as a key element of the strategic planning of governments. In recent decades, the scope of the energy policy as a way of improving the security of supply has widened to include not only the accessibility of resources and the stability on their production, but also, among other aspects, the environmental and social sustainability involved in their exploitation. Both the major nations and those with growing political and economic importance, along with other players in the energy sector, whether public or private, currently make up a network of interactions and alliances that is giving rise to new rules in the field of energy. There is a new geopolitical energy game with renewed tension and uncertainty, with a change of paradigm in the field of supply and demand, with price differences between regions increasingly pronounced, and with more players and new technologies that are transforming energy as we have known it up to now. Which are the challenges faced by the global energy industry in the near future? This new global scenario will have to face different challenges from demand and supply sides. First of this is the world's growing population. In the last 50 years, world's population has tripled, and if you are over 50, you will have seen the population of the Middle East grow fourfold. Global population growth is slowing, but is still set to grow from 7 billion today to 9 billion by 2035. Second, the global economy is growing. While there is a lot of short-term noise, the long-term trend is for the global economy to keep on growing at an average of 3.5 a year out to 2035. And third, energy consumption is growing. In the last 2 decades, energy demand grew by about 50%, and in the next 2 decades is expected to increase about 40%, which is the equivalent of adding another US and another China to world energy consumption. Taking into account those 3 growth statistics, the big challenge in terms of demand for energy is evident. The energy challenge faced by the world is how we balance meeting the increasing global demand for affordable and secure energy while tackling climate change. Maintaining a sufficient supply of reliable, affordable, and sustainable energy is essential for global growth and development. With world energy consumption expected to double in the first 50 years of this century, with the majority outside of OECD countries, access to resources becoming even more difficult, and climate change increasingly urgent. The energy challenge we cope with is complex and multifaceted. Moreover, there are additional risks jeopardizing the setting. To that big challenge, you may add global concerns about carbon, particularly concentrated in Europe, as well as conflicts and tensions affecting many of the oil and gas producing areas of the world. However, it is not the first time the energy industry, and specifically the oil one, well represented in this venue, is facing deep and turbulent challenges. Major changes have been a constant backgrowth in this industry's work. The oil business has been dealing with uncertainty since it began. The difference today is simply in the volume, the speed, and the diversity of turbulent events that are occurring. We have conflicts across the Middle East, in Syria, Iraq, Libya, and elsewhere in the aftermath of the cold Arab Spring. We also have the continuing tension between Ukraine and Russia and various related sanctions. We have tension in several areas of the Pacific. Climate change remains a major risk for the planet. Yet, one of the competes for government that attention with more immediate concerns over security and the economy. And economic uncertainty is driving a new wave of volatility in the oil price. Anyway, the reaction of energy industry is positive. Nevertheless, as many times in the past, the energy industry has reacted steadily. Technically, nobody could deny that we are living an innovation spring. New resources, new technologies, new partnerships flourish all over the world. One of the most important demonstrations of this is the energetic revolution in the USA. It's extremely impressive and very important in political terms, economically, and as well geopolitical consequences. Precisely, you can call about the Atlantic Renaissance in energy. I have the opportunity to be the chairman of an initiative under the umbrella of the Johns Hopkins University in Washington, and a program to research all the possibilities of the Atlantic Basin, the so-called Atlantic Basin Initiative. In the Atlantic exist the largest reserves of oil, gas, raw materials, food, and water in the planet. If you consider all the Atlantic Basin. And we have created an Atlantic Basin Initiative and an Atlantic Energy Forum, as we celebrate precisely our first meeting last week in Cancun, Mexico. And we established some key points for us, for our work in the future. Develop an open market for energy products, materials, equipment, and services. Remove technical, administrative, and fiscal barriers to trade and transit in energy. Facilitate to access to capital, investment, and private-public financial institutions. Strengthen research, innovation, and new technologies for the exploration, development, and of the energy resources. And establish an Atlantic Charter for sustainable energy, an Atlantic Action for energy access. And we must work in the redaction of an Atlantic Charter for the future. And I appreciate very much the possibility to establish a serious cooperation between this initiative and this strategical center. Anyway, today, nobody, I repeat, doubts about the technical possibility of meeting the growing demand for the next decades. New discoveries of conventional hydrocarbons with potential to be commercialized, the surge of unconventional oil and gas, the good results of new technologies, and the affordable development of some renewable energies guarantee a level of supply capable enough of meeting the increases in demand. All sources of energy will play a role in the future, and that means that oil will continue to play a leading role in the world for a long time. Obviously, these increases in security derive from an intense process of innovation combined with the current level of uncertainty in some parts of the world involves tension in prices. I believe that security of supply and security of demand are equally important. We want to secure prices that are both predictable and affordable. We all remember oil prices reaching $147 per barrel in summer 2008, then crashing to less than $40 6 months later, of the current situation. But this kind of volatility creates uncertainty, affects the economy, and undermines investment. It is a surtax to promote transparency and stability in a global energy market, which will be profitable for all. As you can see, I'm really confident on the future technical possibilities of the energy industry in dealing with the challenge ahead. Coming from Europe, this message is even more valuable. Europe is leading in this new global energy game. The deceiving economic development, the excessive burden of very expensive welfare states, the unfinished institutional framework, and the lack of leadership and political willingness to move forward are making Europe fall behind in this race. You pay gas 4 times more expensive in Europe than in the US, for instance. And the competitiveness in our countries is more weak. But there is no doubt that the new European Commission has a lot to do in this field. It is time for Europe to put energy on the top of the agenda. It is time for Europe to bet for a more balanced equilibrium among security, environment, and competitiveness. It is time for Europe to play a more active role in those events that are jeopardizing the future prosperity of the continent. The new energy landscape requires a different, more agile diplomacy than in the past to guarantee both our energy security and our wider safety. Energy issues are clearly both drivers of and driven by geopolitics. The present Middle East political turmoil presents an acutely vivid picture of the dangers to conventional energy patterns. We needed order, clarity, transparency, and stability. This will be vital, not only for the region, but for the world. And I appreciate very much this invitation. I can express my gratitude and congratulate this center and this forum for this 20th anniversary. Happy birthday, 20th anniversary for this center, and thank you very much. Thank you.
شكرا معالي خوسيه ماريا
We thank Mr. Jose Maria Aznar for his speech. And now for the final statement for Dr. Jamal Sanad Al-Suwaidi, Director General of the ECSSR, that I will deliver on his behalf.
بسم الله الرحمن الرحيم.
In the name of God. Your Excellencies, ladies and gentlemen, Assalamu alaikum. I have the pleasure, brothers and sisters, at the end of this 20th annual energy conference regarding the geography, the geopolitics, to convey to you on my behalf and my colleagues and in your name as academics, thinkers, researchers, and experts, all thanks to General Mohammed bin Zayed Al Nahyan, heir apparent to Abu Dhabi and vice and head of the ECSSR for sponsoring all the annual conferences of our center, including this one, and the unlimited support to the center and to the conference to achieve its goals. And I have also to mention, brothers and sisters, to express my thanks and appreciation to you all, researchers, experts, and discussants, because you contributed through your research papers and your serious discussions and all the scientific panels to reach the recommendations and to have a clear vision of the future of energy and its trends, especially in the fields of creativity, innovation, and international markets and geopolitical changes. It is important for me to see that your recommendation will see their way to the policymakers in the UAE or in the GCC countries or the other producing countries in OPEC or outside OPEC, and to all the concerned in the future of energy in our modern world, so as to be adopted and translated into strategies and policies and decisions to serve our people and their welfare and their security, and to guarantee the future of the generations to come. Thank you very much, and I wish you a pleasant stay in our country, the United Arab Emirates. God bless you, and see you in the future in other meetings. Thank you.